Hero MotoCorp is the top Nifty gainer after moving almost 3%. A strong set of sales in July led by the scooter segment does well for the company. The management also expects volumes to rise in the upcoming festive season.
Delivery surges following a strong set of numbers. The stock is up close to 4% as the net profit surges by 70%, while the margins also expand. The management also expects double-digit growth going forward.
MCX rises, reports strong sequential growth while EBITDA margins too hit a multi-quarter high. The stock up 5.5%. The board also has approved a stock split in the 1:5 ratio.
ABB India corrects as margins contract and order inflow comes in under pressure in the first quarter. Tata Power also slips following first quarter numbers.
UPL rallies post their numbers on Friday and declining there because brokerages are positive. HSBC and Kotak both issue notes on the stock.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see to the top of the screen, well, most of the indices are trading in the green. It's been a volatile morning, flickering between the green as well as red terrain. There are a couple of parameters that are in the oversold zone. So that's why there is hope that there could be some kind of a bounce, though the structure is looking a little bit weakish till we get past the 24,850 mark and then all eyes on the 20 DMA. Hey, Mangalam.
Hi, Nigel. We take that point entirely. There is volatility. We are close to, oversold zones, but we have a bunch of triggers to watch out for as well. The RBI monetary policy meeting underway this week. The outcome is something that we'll watch on the 6th. Meanwhile, just keep an eye out on a couple of stocks from the broader market. Godrej Consumer reports its numbers in the next fortnight or so. The stock is lower right now at the low point of trade. ABB India, Vamakshi told us that the margins were amiss and the conference call is currently underway. That stock has moved to the low point of trade, so keep an eye out on that one. And PNB Housing Finance, it was the stock of the day on the downside on Friday, entered F&O ban on day one of the series as well, and now currently selling off a little further, down 4% at this morning. What we'll do is, in a market like this, get you some ideas for profit. Our colleagues from Money Control Pro join in. Today we have Neha Dave. Neha.
Today's stock idea is 361 Wealth and Asset Management, the largest non-bank wealth manager, which is one of the key beneficiaries of the structural growth in the wealth management industry. No wonder the company reported its highest ever quarterly profit in Q1 FY26 on the back of robust growth in assets. AUM growth was driven by strong inflows and mark-to-market gains supported by a rebound in equity markets. The strong inflows during the quarter was also due to additions of distribution asset of BNK Securities that was acquired last year. This could more than offset the outflows from the wealth management segment resulting from the team attrition. While the company's total asset under management, distribution and advisory stood at over rupees 6,60,000 crore as of June end, management's focus has been on growing assets that earn recurring revenue. Recurring revenue constituted around 77% of the total revenue in Q1 FY26, which is very positive as it reduces earnings volatility. In terms of valuation, the stock is currently trading at around 31 times earnings estimated for FY27. Valuation looks rich when compared to return on equity of around 20%. However, it is important to note that the return ratio is currently compressed mainly due to recent equity dilutions and inorganic growth strategies pursued by the company. Outcome from such strategies are rarely linear. The recent acquisitions, especially the collaboration with UBS, have the potential to significantly alter the growth trajectory of the company, with the results becoming evident over the next few years. Long-term investors should accumulate this stock.
Okay, all right. Thanks a lot for that, Neha. For the time being, we slip into a short break. On the other side, we go full throttle on managements. We have the management of RK Forgings who will be joining in. Stay tuned.
Welcome back. You're watching us here on Chartbusters. Let's get chatting with the management's post their numbers. And today, the first one on our radar is Krishna Forging. Remember, the company reported a muted set of first quarter numbers. The management has given a healthy outlook for the second half of this year, and which is what explains the stock's outperformance versus its numbers. Naresh Jalan, who's the managing director of the company, now joins in to discuss their first quarter numbers. Thanks a lot, Mr. Jalan. Understandably, it was a weak performance given the global uncertainty that we are seeing. But you remain confident of this 15 to 20% volume growth for this year. If you could give me two numbers, going forward, what proportion of your revenues comes in from exports, and split this 15 to 20% volume growth in both domestic and exports business. And the second number is the capacity utilization that slipped to sub 70% in the first quarter. Where do you see that number headed by the end of this year?
Good morning. I think our past export performance was close to 60% domestic and 40% exports, and which premix right now has changed to 66% domestic and 34% exports. And that's the reason, because mainly due to North America slowdown and consumption in North America being on the lower side. But going forward in the second half of the year, I think most of the new order wins which we have had in Europe are going to play out for us, which makes us very confident that our export premix in the second half of the year is going to go back to 40% plus, and we will be able to clock the revenue growth as per guidance.
All right. And volume growth, sir, will be around that 15-20%. That's doable?
Yes, that
with margins, yeah.
With the increased capacity, which has been augmented over last 1 year, and which most of our capacity is going to get completed in terms of our expansion by this September end. So I think we are looking at almost 15 to 20% volume growth in the second half of the year.
And margins will improve substantially from these levels, because first quarter has been weak, but you were guiding for 21-22%. So by which quarter does it hit those levels?
I think on a standalone basis, RKFL margins are going to, by fourth quarter or first quarter of next year, going back to the old margins of 20-21%. And with the new capacity of castings being augmented, castings will always remain a lower margin business. So we are looking at 16-17% margin from the casting business. So overall, on a console basis, we are looking at almost 19 to 20% margin going into first quarter of FY27.
All right. So 19% by the first quarter of FY27. If you could give us the split in terms of the growth that you anticipate in your export and domestic business this year. First quarter exports fell by 19%. The overall year, you expect on a consolidated basis to grow between 15 to 20%. If you could split that up between export and domestic, and in export, if you could split that further up into US and Europe, because, your Europe contribution has been increasing over the years. Where does that stand at, and what pace is that likely to grow at?
So I think to answer your last question first, I think our Europe exports are going to double down going into second half of the year and into next year. So most of the growth in exports are going to come from Europe. And from North America, non-auto segment is going to grow for us vis-a-vis the auto segment. So both these taken together, I think our export volume should by the year end grow around 10% year on year. And we are pretty confident to maintain this growth into next financial year also.
Okay, exports grow 10%. Overall, you expect to grow 15 to 20%, which implies that a lot of the heavy lifting will have to be done by the domestic business as well. In US and Europe, what is the revenue split right now? And what is it likely to be going forward, since Europe is doubling and US is still under pressure?
So in the current quarter, the volume is close to around 70-30. 70% has come from Europe and 30% from North America. And going forward, I think with non-auto segment from US, North America market going to do well in the next half of this financial year. I think the premix is going to be growth-wise, the new volume which is coming in, 60% is going to come from Europe and 40% is going to come from North America.
Okay, all right. What about the railway business, sir? You have some orders in hand and you are guiding for better times ahead. So on an annual basis, what kind of revenue potential do you see from the railways business? And say in the next 3 years, where do you see this business scaling up to?
That is the main reason why we are looking at domestic doing extremely well for us. I think exports, railway business is going to compensate the major growth part which is going to come in RKFL for next 3 years. I think with the new approvals which we have received for manufacturing the complete assembled undercarriage, which is going to start production from the second half of this financial year. This is going to double our business from railways for the passenger segment. And I think this is the path wherein we are going to continuously grow, and that's a heavy lifting going to come in the domestic industry. Railway, we are extremely confident that this financial year we are going to double our revenue from exports with the previous year. And this growth is going to continue with the kind of healthy order book which we have had from railways right now, which is going to continue for next 2 years' time.
Give us a number, sir, absolute number.
We are looking at almost by end of FY28 to do close to around 750 crore to 800 crores revenue from Indian Railways.
750 to 800 crore from Indian Railways by FY28. Just two numbers before we let you go, sir. The first one, I remember AICL, you were targeting 500 crore revenue in FY26. Are you on track for that? And could you give us an FY28 number for that? And the second part, you were expecting autos to be 70% and non-autos to be 30% of your sales by FY26 as well. Are you on track for that number? And do you have an updated guidance for that for the next 2 years?
So in terms of our auto and non-auto, we are on track. And I think we should be doing by FY26 end almost 70-30 in terms of auto and non-auto. And this premix should further improve going into next financial year or probably by FY28. And in terms of ACIL, ACIL is now already a merged entity in RKFL. We have already, last year itself, we have merged this on RKFL. And we have started getting almost 15 crore rupees revenue from ACIL in terms of their own contribution to the balance sheet. I think it's because of company coming from NCLT, and it has taken more efforts. I think going forward in next 2 years, we should look at a very healthy revenue and margins from ACIL.
So 500 crore happens when? Annually?
So annually, I think it will take another 2 years before we see that kind of revenue from ACIL.
All right, take that point. Thank you so much, sir, for joining in and giving us a detailed outlook on the prognosis of your business for the next couple of years. Slight delay in ACL, slight sluggishness in North America, but you are more than making up for it by growth coming in your railways business and growth coming in from Europe. Non-autos would be 30% of your overall business by the end of this year, as guided earlier. Thank you so much for joining in. Wish you good luck for the remainder of this year. With that, we'll slip into a short break. And as we do that, here's some good news for all your viewers. India's business news leader, now just a click away. Introducing CNBC-TV18's all-new app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store. Just scan that code, which is up for you on the screen.
Welcome back. You're tuned into Chartbusters. You're on CNBC-TV18. Well, Skipper's the next stock on our radar. Reported a strong showing in the first quarter, registered record quarterly EBITDA, while order book as well was at record highs. We have Sharan Bansal, Director of Skipper, who joins us on the show. Hi, Sharan. Good to see you win. Well, good set of numbers. It seems the street liked it, and it appears you'll have an industry tailwind as well. And, the numbers seem to be picking up from here on. But for the first quarter, the growth that you've delivered is close to around 15% approximately. For the year, you were guiding for a 25% growth. Do you think you have enough in store to achieve that 25% and make up in the coming quarters?
Hi, Nigel. Yes, absolutely. We are fairly confident that 25% growth is very much doable in this financial year as well. We have grown very significantly. We've had more than 100% growth in the last 2 years, starting from a 2,000 crore top line in just 2 years ago in FY23 to ending with a 4,600 crore top line in FY25. Even from this elevated base, we are fairly confident of delivering another 25% growth. And that's going to come about on the back of our capacity expansion, which we commissioned recently. That got commissioned in Q1 of this year. So we did not get the full benefit of the new capacity in Q1, but from Q2 and 3, we expect to get the full benefit. So looking at the order book, which is 8,000 crores plus now, 25% seems definitely on the cards.
All right, 25% seems on the cards on account of the orders that you already have and the increase in capacity. But there are a couple of, headwinds as well. One of them is the shortage of manpower. The second is that you have increased your exposure to the US, where uncertainty around tariffs are underway as well. So in light of all of this, what does the order pipeline look like? We've looked at around 30,000 crore worth bidding pipeline that you've spoken about. Given the historic 20-25% sort of run rate, do you think that an additional 7,500 to 8,000 crore of order wins can be possible this year?
Okay. In terms of manpower, yes, you're absolutely right. That remains the biggest challenge in terms of ramping up execution. We are taking a number of steps in terms of recruitment, upskilling, and training of manpower, and hopefully that's something which we will be able to deal with in line with the enhanced execution. The US currently makes up just about 1% of our order book. So it's not really significant for us as of now. And the situation on the tariffs is a very, very fast evolving and a dynamic situation. This is really something which we will have to wait and watch to see which direction it goes. However, we have enough opportunities in a number of global markets. Middle East is something which is very significant for us. Recently, in this quarter, we secured a very significant engineering order. It's not a supply order, it's a pure engineering order for Middle East's largest utility. So that is quite significant for us as well. And we have sufficient amount of opportunities in other markets like LATAM and Australia as we speak. So the pipeline, of course, like you mentioned, is healthy at 30,000 crores. And even if I consider a conservative 25% hit rate that we have been delivering over the last several years, our order intake guidance of about 6,500 to 7,000 crores this year should be very much possible.
Okay, got it. And exports as a percentage of mix, where does it stabilize at?
Exports as a percentage of our order book as of now is just about 10% overall. In terms of our execution this year, we expect this to be somewhere around 15%. We have been taking in export orders roughly to the tune of about $100 million every year, roughly 7 to 800 crores is what our export order intake and execution has been. This year, looking at our enhanced capacity coming online, where we will be able to take on more short-term export orders as well, and looking at our increased penetration into a lot of key markets like the Middle East, which I mentioned earlier, we believe that we can easily aspire to double our annual export order inflow from $100 million to about $200 million annually. So this is what our target will be to intake in this year.
Wow. So you are looking to double your export execution. Could you give us a sense on what does that do to your margins overall? Because there are two drivers as we see it. One is increased exports coming in. What's the delta between domestic and export margins? And secondly, some of these high value T&D contracts with increasing complexities that you are delivering, what do they account for in your overall sales mix right now and your order book? Where do they go from here on?
Okay, so I just want to correct that in terms of export execution, it will be in line with, as I mentioned earlier, about 15% this year, because on the back of our order book that was there last year, our guidance for higher exports will be the order inflow for this year,
Got it.
which will result into execution of next year, perhaps. In terms of margins, definitely exports have a better effect on margins, and they come with about almost 1.5 to 2% better margins. Company has been consistently improving on margins also. If you look at Q1, we've delivered about 10.1% EBITDA compared to 9.6% overall last year. So we believe that overall 50 basis point EBITDA for the full year is very much possible for us as well. And in terms of the high value T&D projects, yes, we are executing a number of them. Most of our projects are in the highest voltage category, which is 400 and 765 kV and 800 kV HVDC. So yes, certainly as those executions come in to play, we can expect better and better margins ultimately to get to the long-term aspiration margin of 12% in the company in the medium term.
Okay, all right. What about working capital days? They had improved last year on a steady state. Where does it stabilize at?
Yes, you're right. We were able to improve working capital to just about 90 days last year. We believe that certain more optimization is possible. So we should be able to bring it by reduce it to another maybe 10 days or so in this year. We are at the best working capital days in the industry as of now. And in terms of what we are more happy about is the finance charges. We have been able to deliver a significant improvement in finance charges as a percentage of revenue, which was about 4.6, 4.7% of revenue last year. This year, if you look at Q1, we've already delivered about 4.2. And I think for the full year, we should be closer to 4% or as a percentage of revenue.
Finance cost as a percentage of sales from 4.5, it's come down to 4.2. You'll end at around 4%. And the working capital days, sorry, I missed the number.
We're at from 90 to about 80 days we should be able to achieve.
And very quickly, the polymer part of the business, that's a smaller vertical that's growing quite fast. Any signs of slowdown for the year on an annual number? What can you tell us? What will you achieve?
Polymer, we are very happy that we have delivered a good set of numbers despite not much business coming in from Jal Jeevan Mission projects. Those are pretty much non-existent right now. But despite that, the increase in plumbing sector business has led to this increase of volumes and execution in this vertical. And we are confident that overall in the year, 30 to 40% growth in this vertical should be possible.
All right, 30 to 40% growth. And just a one-word answer on infra. It fell 39% this quarter. What's the outlook for this year?
Infra is just a function of, the project execution. So again, overall for the year, we are pretty confident that we should be able to get 20-25% growth in this vertical as well. Again, quarterly execution may vary from certain quarters depending on the context.
Take that point, reasonable there. Thank you so much for joining in, Charan, and giving us an outlook for this year. Wish you good luck for the execution part and order inflow part for the entire year as well, with 50 basis points margin expansion. With that, we're out of time on this edition of Chartbusters. Thank you so much for watching. Stay tuned to CNBC-TV18 as Trading Hour comes up next.